My name is Michael Guyette, publisher of the Lead Lag Report. Joining us today are here Rick Palacios, Director of Research, John Burns, Real Estate Consulting. And I think this is going to be a very timely conversation because I think it's becoming more and more clear that housing is probably in trouble, but it's always a question of by how much. So, Rick, for those who are not familiar with who you are, talk about your background, how'd you get involved in markets and real estate, and what it is that you're exactly doing right now.
Yeah. So for the bulk of my professional career, I've been an analyst focused on the residential real estate space. Um, Came into it around '05, '06, which was an opportune time. Even interned at Countrywide Financial, if those that remember, back in the heydays of subprime when I was in college. So learned some lessons there, processing loans for sure. And in terms of just overall background, I've worked with the firm here and now from entry level analyst to now our head of research about 11 years or so. And in between, worked at the Milken Institute, which is a think tank here in Southern California. And I was focused on the housing mortgage industry right in 2009 after I came out of grad school. So it was a fantastic time to be in grad school and a fantastic time to be focused on the housing industry as well, given the GFC. And then also had a brief stint at Morgan Stanley doing sell-side research on home builders. And for those not intimately familiar with just the firm as a whole, we've been around 20 years, and it's our job to really figure out what's going on at the local markets across the country as it relates to housing. And our client base pays us to figure out exactly what's happening, what our short-term view is, medium term, and then long term. We forecast all the way out to 2025, believe it or not. And I think my favorite part of the job is we learn so much from our clients because it's everyone on the industry side, from land developers, home builders, clearly building product manufacturers, distributors, rental operators, both single family rental and then now build for rent apartment developers, everybody that's lending into the space. So we learn just a ton in interacting with our clients, and we publish a ton of research for anybody that follows me on Twitter. You see kind of the little tidbits and breadcrumbs of what we do. And I'll stop there, Michael, because I'm sure people want to hear exactly what's going on in the market right now.
Yeah, no, that's great backdrop. Okay, so the thing that's obviously in the media quite a bit now is the focus on how mortgage rates have utterly spiked as yields have spiked, obviously, especially with the way treasuries have behaved on the longer duration side. And it seems to me that there's this belief that housing is going to decelerate, but not necessarily reverse in terms of value. I want you to talk about historically how have these types of mortgage rate shocks ended up impacting housing, the momentum that's behind purchases, and what's the typical lag in terms of when you actually see that with prices?
Yeah, so everybody hones in on prices, and specifically on the resale side, it's actually the last place that you see the slowdown show up. One of the first places that you see it show up, which is it's so great that we're so close to the home building space. It's real time what's going on with home builders, and we've been surveying home builders across the country for the last 14 years. We do it every month. During the spring selling season, we actually do it a mid-month channel check as well. And we started seeing signals of that happening all the way back to probably February or March when rates started creeping up. And just in the last couple of weeks, which is when rates have now touched 6% plus, it's pretty clear. I mean, builder sales offices are going to be fairly quiet, is my guess as we go into the weekend. And I mean, this isn't just us just kind of throwing statements out there. I mean, we just surveyed about 100 or so home builders through the first 2 weeks of June, and back in February, almost 100% of home builders were raising prices on a month-over-month basis, and that has collapsed. And the commentary we picked up in the first weeks of June is that almost no builders are raising prices right now on a month-over-month basis, and traffic in their communities has slowed massively. Traffic to their websites has slowed massively, and you're starting to see more and more incentives thrown at the buyer to try to nudge them into purchasing a home, whether it be buying down the rate on their loan, giving them some money to go and spend in the design center. And then where you're seeing actual price cuts right now, I mean, it's happening real time with home builders, is where they have standing inventory. So this is something that the industry refers to as spec or speculative inventory, where you start a home without having a buyer in place. And that that was the model really the last probably year or so, where builders were trying to kind of get out in front of costs and didn't want to price a home until they were later in the construction stage, because costs were ripping higher, their home prices were ripping higher. They wanted to capture some of that margin. That works really well when times are fantastic. And then as soon as the market shifts, and if it shifts on a dime, the story works the exact opposite way. And so you do not want to be sitting on standing inventory when the market changes on a dime. And that's now what's happening. And so where builders do have standing inventory, especially if it's catered towards the entry level buyer, which is extremely sensitive to the mortgage payment shock that we've now seen with 6% rates, that's where builders are cutting prices already. And it's not massive haircuts. Right now we're seeing 10%, sometimes 15%. Again, it's not universal across the country, but it's definitely
that. Yeah. Sorry, you were breaking up a little bit, but I don't know. Maybe if you can be a little closer to whatever internet you might be on, or if it's the cell phone. But okay, but let's go with this point about the spec build, because I think this is interesting. This idea of kind of buying without having a buyer in place, or building when you don't have a buyer in place. When did that really accelerate? Because obviously we know COVID changed a lot of these dynamics, but where did that really start to kind of get to be a almost like a mania among the home builders? So I was asking the question, just to repeat the question. This point about the spec build is interesting. When did that really start to go vertical? When did the mania kind of really start to maybe kick in among these home builders that wanted to build out these homes, just hoping that there will be a buyer when they're done with it?
Yeah, I think it really started to surge probably in early 2021, because that's really when it was just ridiculous coming out. As soon as we got into really May of 2020, it was off to the races for the entire housing industry, and they were just trying to build as many homes as they could and as fast as they could. And what a lot of builders started pivoting to in 2021 was exactly what I was mentioning, just on trying to do more speculative inventory. And the reason there was just because they did not want to price homes early in the process, because it was very hard to get visibility around what was going to happen on the cost side. And so they wanted to wait a little bit, a lot of times before when they got to drywall, because they had a lot of visibility on the cost side there, and home prices were ripping up so high during that time period that they could capture the cost side of it, push it onto the consumer, and capture a lot of the margin upside in home prices. So that was really a big part of builders' plans all throughout 2021 and even into early 22. And then it started to flip over as soon as the writing was on the wall with what was happening with rates, and then clearly now with what's going on in the economy. And I think now it's pretty much consensus that we are going to be going into a recession in 2023.
How does that compare to the lead up to the peak in housing? I think it was in '06, right? When you had cranes everywhere you looked in Vegas and in other areas, right? Now that's obviously not on the home building side, but it's all partially related, right? So how does that spec inventory build compare to prior cycles?
Oh, it's nowhere near, which is good. That's a really good thing, and that's where that there's a lot of kind of extreme bearishness, and we're going into a crash. And our view is that is not in our base case. Although there is going to be a slowdown, we are expecting prices to decline and construction volumes to fall. But the good thing is that if you look on the lending side, we have not been doing crazy wild loans over the last 5-6 years during this time period. And the industry as itself, it did not get out over its skis. And there's a variety of ways that you can look at that and cut the data. But builders did not this cycle go out into the C, D, F submarkets, where it's a drive till you qualify for the loan type of housing market, and that should help the industry weather this slowdown better than it did clearly in the GFC. And the other thing too is if you look at just the balance sheets of public builders across the industry, the lion's share are they're pristine. They've never looked so good. So I think the ability for them to weather this slowdown is much better than what we saw during the GFC. And it kind of brings me to a point that we've been communicating to our clients for the past 2 or 3 months. And now you're seeing the Fed essentially do this, where I think that the Fed is using housing as kind of the sacrificial lamb right now to just slow everything down. And it's one of the only levers that they can actually push and pull to have an immediate impact on inflation. And we're all seeing that right now. I mean, as soon as they started to move both on the short end, which doesn't really necessarily impact 10-year rates. I know you mentioned that earlier, but what they're starting to do, flipping from quantitative easing to quantitative tightening, I mean, that's having an immediate impact on what's going on with long-term rates and obviously mortgage rates. And so I think when the Fed kind of looked around and said, hey, what industries out there can we try to slow down and not just have a massive impact on the broader economy? Housing is actually one of those industries, because the industry as a whole just did not get out over its skis, way over leveraged like it did during the GFC. And unless this ripples out into a banking type of crisis, financial markets type of crisis, because then everything just gets gummed up and recessions turn into quasi depressions. And so that's not in our forecast, but unless that happens, housing should be able to get through this without a massive amount of pain.
Yeah, and you bring up a good point with that. And I keep referencing that, whenever the Fed talks about the wealth effect, they're really not talking about stocks. Right? They really are talking about housing, because the vast majority of people's assets are in their homes. It's not necessarily through, a particular ETF, right? So it makes sense that that's the transmission mechanism. Now, I want to get a little bit in the weeds here, because it's kind of, just knowing the details, I think are interesting. So home builders, they obviously have to buy a bunch of lumber, they have to buy a bunch of commodities, buy a bunch of things to actually build the home. Um, would home builders simply, rather than stopping the build, just say to themselves, well, if commodity prices are high, I'm willing to accept a smaller margin, meaning they eat some of that commodity cost? Because I have to assume that that's a way that you can kind of keep the party going. It's just not going to be as exciting.
Yeah, so you hit it on the head. What we anticipate happening right now, and again, it goes back to my comments about just kind of the broader industry. Home builders are reporting the highest gross margins they've ever reported in the entire history of housing. So just kind of take a moment and like wrap your head around that. For all of the noise and volatility and issues with supply chain, they're cranking out the highest margins they've ever had. I mean, there's a lot of builders reporting close to 30% gross margins. And so,
what's the driver of that? And what is that really just a function of the demand is so much more that they can get a bigger price? What's the driver of that margin?
Oh, it was 3% mortgage rates, even 4%, and just the work from home source. I mean, everything that's been written about over the past couple of years, and just buyers willing to go out because they could get a cheap loan and there wasn't much supply out there, especially on the resale side too, and saying, hey, I will pay whatever it takes to get this house. And so builders were able to push price for the last couple of years, and that all manifested in crazy high gross margins. And so it's almost counterintuitive. Whereas now, because builders are sitting, especially on some of these homes, and it brings me back to the comment on standing speculative inventory that they've got, because those homes they've got embedded gross margins at close to all-time highs. It probably is going to make it so that builders are more inclined to drop prices faster, because they're going from, say, a 30% gross margin all-time high to, okay, now I'm going to cut prices maybe 10%. I already know what my cost of goods sold were on these homes because they're done. And so, yeah, so maybe margin goes to 22 to 25%. And there's obviously some range in there, but a 22 to 25% gross margin is actually a normalized, slightly above normalized gross margin for a home builder. And so that's where I do think you are going to see builders willing to flex down on price for some of the standing inventory that they've got, because they're dropping from a super high margin to a relatively healthy margin. Now, that story doesn't last forever, because you don't have a ton of homes that are sitting on all-time high margins right now. But it is an interesting thing to think about. And then the other thing too, I think, is there's a little bit of a first mover advantage here, where if you look at the census numbers on construction under development and starts, and I know that number just came out this week, the pig and the python, there's a lot of supply coming. So there's a supply wave that we all see. We all know it's coming. It's probably going to hit some of it towards the end of 2022 into 2023. And so I think what builders realize is, look, let me get the first mover advantage here. Let me cut prices on this stuff. And I don't want to have to be doing this when this wave of supply starts to percolate as we get into 2023. So I do think that that is part of what is happening. And the game plan, from what we see in terms of how this shakes out, is you're going to get a combo of flexing down on standing inventory prices. And then you're going to get also that coupled with, if builders have loaded up on land, and a lot of them have over the last couple of years, they can kind of sit tight, ride out this air pocket that hopefully doesn't last all that long, and just moderate the pace of starts. They can pull back on land buying, and they can also pull back on permits that they're pulling. And that's a very smart thing to do, and just conserve cash to see how long this slowdown lasts.
Before I bring up Joe and Daraj here for some questions from the audience, I want to hear your take on this line that there's this housing shortage, right? Which, and you kind of alluded to it, that there's not a ton of homes out there. I've always thought it to be a little bit of a strange concept, in the sense that the estimates I've seen are that there's something like 3 million homes that are short, but against that backdrop, you've got something like 10 million second homes, right? Homes that are not primary residences.
Vacancy. Yep.
Right. Which is, I saw some tweet about, if you looked at Louisiana, you looked at New Orleans, the number of Airbnbs, it's like almost the entire city of New Orleans, right? It's not people actually living there, right? So, but I want you to talk about that, because this narrative has been out there that that's one of the reasons housing is going to keep on advancing. But if that's really driven by a misallocation of capital, which is causing people to get very wealthy to end up having them diversify their wealth in second homes, then I would argue that's kind of a false narrative. But what's your take on that?
This is the good thing about us having a chief demographer in house, and so our number is nowhere near the 3 to, I think you've even seen numbers close to 5 million that say we're undersupplied or a shortage. The number that we have right now is around 1.6, 1.7 million units, and so it doesn't tie to the numbers, I think, that get covered a lot in the press. And a lot
and
of that.
And how does that compare to the past? How does it compare to like prior cycles? Those numbers.
That's a good question. I don't know that number off the top of my head, but what I was going to say was, a lot of the number and the math that you ultimately come up with on that undersupply figure, it really depends on your starting point in time for when you start running the analysis. And so, like, if you only look at 2010 to current, your number is going to be massively higher than ours. Because technically, yeah, there hasn't been that much building right now. But our number actually goes back and looks at, okay, well, how much did we actually oversupply the market during the run up in the subprime crazy days? And everyone knows we massively oversupplied the market. So you have to think about that. And then you have to factor in, okay, 2010 to current. Okay, now we're adjusting off of that, and we have to make up for all that oversupply. And so that's where our number is significantly less, I guess, inflammatory than some of the numbers that you see out there. Yeah, no, it's a good question, and one of the things that I love doing is going through and just reading all the comments from our home builder survey, talking to all of our clients. And this is the first month, and I'm speaking just on the last couple of weeks here in June, where I have seen commentary about costs starting to flatten out. Costs, actually, the rate of increase is starting to fall off, and that's not just lumber. I think everybody knows that's been happening with lumber, which is going to take a while. There's a lag there before that rolls through for a builder, but I do think that we are starting to see the input costs for home builders start to moderate and even come down, which is going to be a nice relief for home builders for sure. Yeah, I don't have an exact figure, and I know it's different for every product segment. But if home builders are telling us that they're feeling and seeing it already, and then I expect it to be happening pretty soon here for a lot of the different input costs. I mean, if there's massive demand destruction across the entire housing industry, it's very hard for a supplier to go to a home builder and say, "Hey, we're continuing to jack prices here." It just doesn't make sense. Yeah, so I think you're asking how negative our outlook, and to kind of sum up our view. I mean, we are anticipating construction volume declines over the next couple of years. We are anticipating uh, price declines, and I think that's probably a non-consensus view, particularly on the new home side, because builders will adjust prices fast. In a lot of ways, um, they're not forced sellers, but they will meet the market on price and move on. Whereas on the resale side, a lot of people will decide to just, I'm not going to sell my home. So you won't have as many forced sellers. Yeah, so I mean, we are forecasting mid-single digit price declines at a national level, and we do this at a market level across the country. And there's a lot of markets that I think we all are familiar with that have just been going ballistic over the last couple of years. I mean, think about the Boise's and Austins and Phoenixes of the world, Nashville, where we are forecasting more significant price declines. And I think what was in that question too was just kind of broader views on what's happening in the economy impacting what is happening in the housing market. And I do agree that I think when someone thinks about purchasing a home, it's one of the most important financial decisions they're ever going to make in their lifetime. And they do not make that decision in a vacuum. And so when things start to wiggle across the economy, when the inflation psychology of the consumer starts to ratchet up, and obviously we're there right now, they start really scrutinizing these decisions. And I mean, go back to basics on affordability. When we started the year at 3% mortgage rates roughly, and now we're at 6% roughly, that is a massive impact to your purchasing power. I mean, our math tells us it shaves off roughly a third of what you could afford in terms of the mortgage that you could take on to keep that payment the same. So I think all of those things work in unison together and do have an impact on the buyer psyche. And we're seeing that clearly in June right now.
Before I bring in Mark here, I do want to relate that a little bit to this other counter argument I've heard, which is that you're not going to see kind of a broad based massive decline in housing because you do have these institutional buyers that will never necessarily have to be forced sellers, right? And I'm talking about the kind of Black Rocks of the world. You see these stories about how they're buying up in some cases whole neighborhoods, and obviously the related homes there. How does the this kind of institutionalization of buying homes, how has that as been as a trend over the last several years, and how does that maybe impact uh, pricing going forward, you think?
Yeah. So I wouldn't put BlackRock in that camp. Um, but we did a white paper on investor activity back in March 2021, which seems like a decade ago. And the title of it was Investor Mania 2.0. And we looked at all the different segments of that you could throw in this investor bucket: single family rental, cash buyers, foreign buyers, fix and flip, short term rental. And our view was that, look, when the market's great and interest rates are crazy low and the economy's on fire, this is just, it's steroids. And it fed into our very bullish view, namely on home prices back then. And at the same time, when we wrote that white paper, it was look, the way to think about this is hot money. When things are great, it's here. When things flip and they're not great, it moves on. And that's what we're starting to see in some of the commentary already from um, builders that have been selling to investors. It's that even those investors are starting to pull back. And the big institutions get a ton of attention in this, obviously, but it's really the small mom and pop landlords, fix and flip investors. I mean, spend some time on social media and you can just see all the posts about this, especially when things were good and people were making a ton of money. That is now reversing pretty quickly. And the percentage of housing transactions going to investors across the country, I mean, some of these percentages are pretty eye-opening. You go to a market like Phoenix, Las Vegas, 30 to 40% of all housing transactions are going to investors. And so as we start to see rates explode here and the possibility of going into recession, because if you were thinking of putting a renter in that home, well, now you might not be able to get the rent that you anticipated because the economy is starting to wiggle. So all of these things are starting to have a reversal impact now. And it feeds into our somewhat negative view where if I'm going through and doing forecasts for housing transactions at the market level, for home prices at the market level, and I know 40% of transactions in 2021 and then in the first quarter of 2022 we're going to investors, I mean, you better believe I'm going to haircut what I think is going to happen in that market because of what I know is happening with investors right now. Yeah, I think what you're hitting on is we call it the lock-in effect. It actually it feeds into our view. I mean, we cover the for sale market, for rent, but also do a ton of work in building products, repair and remodel, and it feeds into our more optimistic view on repair and remodel activity, which is good for companies like Home Depot and Lowe's because yeah, people are going to be very very reluctant to give up that 3 or even sub 3 mortgage rate. And the only thing that kind of throws a wrench into that thesis is if there's more significant pain in the economy than what we're anticipating, even though we are in a recession, it's not a massive recession. So I guess we've got more conviction that this turned into some sort of a banking structured credit markets type of recession. Job losses accelerating, then you get people that lose their job and they got to give up that rate and sell that home to move on. But that is not in our forecast right now. So I do think there is some merit to that statement on the lock-in effect should, in theory, keep some inventory from coming onto the market as long as we don't get a significant recession here and people end up losing their jobs. No, thanks. I appreciate that. Our firms, I mean, we have a fantastic team that, it's my job just to kind of distill this information to people. Then we don't have a shadow number, but I think when we look at some of the data that Black Knight provides, the amount of foreclosures that are kind of in the system or that could come into the system based off of what we know right now are not all that high. And I think that does speak to some of my comments earlier on the credit underwriting through most of this cycle. But what I will say that is somewhat unnerving for us when we look at the underwriting quality. Particularly, you have to look at it by product type. And when we get under the hood and look at the credit quality of FHA loans, so these are loans that are going to primarily entry level buyers with not pristine credit scores. There are a large percentage of those loans going to borrowers that have debt to income ratios back end, so it's all of your borrowing costs that are significantly elevated. I mean, you're talking 45% plus debt to income ratios, 650 and less FICO scores. So that does give us some worry because if the economy cools off here and people start losing their jobs and home prices collapse or even decline 10, 15%, those homes, if you bought in the last probably 6 to 12 months in some of the markets that are starting to correct here, those homes could be underwater. And so, it's just something to think about, and every market's different. But, looking at the credit quality by product type is something that we've been spending more time doing lately. I will say, just on credit scores, I think you could make a case. You could make a case that there's been somewhat of an artificial melt up in credit scores across the board coming out of the GFC, and then also during COVID, when just a lot of things that would have dinged a consumer's credit were just.
By the way, if you were wondering why I have lumber and gold eyes, it's exactly because of housing and home builders, because it relates to what's the big driver of the economy, obviously. So give me a second here. Hopefully I'll get Rick back up. There we go.
No, so I think I'm not sure how much you heard of the comments on just credit quality, but I think you could make a case that if you just look at overall FICO scores, there has been somewhat of a melt up in FICO scores coming out of the COVID recession, because a lot of just things that would have dinged people's credit were just put on hold, and so that's a big part of why when we look at especially mortgage credit quality, we like to look at each buyer segment, each product type, and entry level has been a big driver of housing over the last couple of years. And that's where it's important to just look in and say, okay, well, who's driving that? What type of loans? And on the FHA side, we have seen some elevated debt to income ratios. We have seen some deterioration in FICO scores, which are things that we think are important to pay attention to.
Let me get a question here that was DM'd to me real quick from Volatility and Coffee, which seems like a very dangerous combination. But the question he asked was curious if Risk has opinions about the relationships in terms of rents, especially in large cities like New York City, sort of the impact of how rents impact some of your forecasts around housing and sort of distinctions between cities versus non-cities.
Well, I'll tell you, one of the most important areas that we're thinking about rents right now is how it feeds in to CPI. Because I think that probably the most important stat right now, when you look across the economy, is what do people expect is going to happen with CPI? And roughly a third of that is shelter. And a big part of that is owner's equivalent rent, which is a wonky stat, but it's basically what people think they could rent their house out for. And we do a ton of work in the rental space. And I mean, all signs are that rent growth is just continuing to accelerate on a year over. It's up massively on a year over year. We are starting to see signs of the rate of change decelerate, but I mean, you're decelerating from in some markets on new leases, namely on the single family rental side, from 20% on new leases to maybe 15, 16. So, you know, looking at the rental data that we track and knowing what it means for owner's equivalent rent and CPI, it's very hard to imagine rents all of a sudden collapsing, slowing down massively, which does feed into our view on broader inflation. Yeah, so I'll try and hit that in a variety of ways. One, we track the relationship between cost of owning a home and cost of renting that same home, and the spread on that is now the highest that we, I believe, have ever seen. Which and then a lot of that is just due to what's happening with mortgage rates right now, and so that is immediately going to feed into an increasing amount of households that thought they were going to purchase a home are now going to be renting a home. And it's one of the reasons that the single family rental industry has actually historically weathered, especially recessions, better than the for sale industry, and then obviously apartments as well, which can tend to get oversupplied. If you think back to, I mean, drilling in a little bit on the single family rental industry, if you think back to the Great Financial Crisis, worst recession since the Great Depression, yet in markets like Phoenix, where, I mean, just the epicenter for a collapse in the economy, in housing, the rental data that we track in single family rentals shows that rents only fell peak to trough. I believe it's about 4 to 5%. And a big part of that was because if you were in a home and own the home and you had to foreclose, you're not going backwards lifestyle wise. You may have a family, you want to be close to a school, so you're not going to go reverse back to apartments. You're going to look for something that's similar, and that's historically and traditionally a single family rental home. So it's one of the reasons that that sector is weathering things better. I think something to watch out for though is when you do have a recession and people are losing their jobs, you can't assume that you're going to be able to raise rents 10% plus in perpetuity. just because the tenant, the consumer, is not going to be able to do that any longer. And so rent growth, in our view, especially if the economy starts to decelerate significantly here, rent growth is going to have to come in. But historically, it's very rare, especially at a national scale, that single family rents actually drop and actually move into negative territory. The other thing that I think is interesting too on this on the renter space is, we've got kind of a working thesis that there was a decoupling or explosion in household formations coming out of COVID, where you had two, three people living together, and then obviously work from home, fear of COVID, moving out, separating on their own, but also because rents came down in a lot of these gateway markets, and now rents have accelerated and blown out, and a lot of these people cannot afford it anymore. And so we do think, especially if there's a recession, that you'll see a reverse of that and people doubling up to save money.
I'm curious, Rick. I gather you're obviously much more focused on the U.S. market, but I don't know if you've done any work on the international side, and what kind of exposure do some of the home builder stocks in the companies in the U.S. have to building outside of our borders? Because this housing boom is not just focused on the U.S., right? It's globally, because obviously COVID was a global phenomenon.
Yeah, so we have our hands full trying to figure out what's going on in the U.S. housing market. Um, I wish we had more time to spend on the international side, but it's not something that I would want to chime in on. Although I will echo what you said. I mean, it has been just a global boom in every developed housing market over the last 2 3 years, and now we're seeing, just as everything kind of moved up in unison, now as every central bank is raising rates, not only U.S. but across the world, that theme is starting to reverse for sure. And one of the things that benefits the U.S. market is that we've got 30-year fixed rate mortgages. That is not the case in a lot of parts of the country, and so when rates start to reset, it has an even sharper impact on housing.
Yeah, no, that's very valid in terms of that dynamic. Okay, I always get these random questions from individuals asking me, and because I've been kind of on this drumbeat that housing is going to decelerate and slow down for several months here, asking the question of, well, should I wait to buy my home, or should I just do it? My response is always, don't view it necessarily as an investment, view it as something different, because you're going to live there, and memories and everything you kind of go through living in a home, you can't really put a price on. But if you were to put some sort of timeline around sort of where you think these trends might not just uh, turn, but bottom out, right, in terms of just the deceleration and when that might end, when do you think would be sort of an interesting period to consider looking more at houses from an investment perspective? How much time is needed for this to kind of flush out a bit?
Yeah, so I will answer that, not on the investment side, but more on the, and I think it echoes your points exactly, Michael. I mean, there's no matter where we are in the cycle, the worst of times, the best of times. I think even in the Great Financial Crisis, there was like 4 million plus resale transactions. Like there's always reasons for people to move. You're relocating, you got married, you're downsizing, whatever it is. And so, yeah, if you find your dream home and that's where you want to be for the long haul, you shouldn't be thinking in 1 2 year increments. And if rates come down in the next few years, you can just refi down all the way through. Um, so that's kind of the way that I like to think about it. I know a lot of people, especially on the investment side, don't think about it that way, but I think, Michael, that's probably the best way to approach it. And if you just use our lens in terms of our forecasts, um, our view is affordability is probably the most important metric to look at for housing, and affordability has to normalize down. Trees don't grow the sky. We can't continue at the rate we've been at over the last couple of years. And so, for that to happen, with rates where they are, you have to have home prices cooling off. And so, we do anticipate that happening over the next couple of years. We do anticipate a recession happening over the next year or so, and then starting to recover in our outer year forecasts, as well as home prices. And so, if you want to just kind of ride it out and you can for the next year or two, you can also choose that path as well.
How do people get access to some of the research that you put out if they're really curious beyond just following you here on Twitter? What do you recommend?
Yeah, I mean, you can message me, and we'll put you in touch with the right people. We publish a ton of research reports every single month. We just did our monthly macro housing econ piece. It's a quick client email that's about 400 or 500 words, but there's about 400 slides that feed into that client email. So, I mean, we are definitely doing a lot of homework on our end. So, if anybody's interested, by all means, reach out.
You're doing a lot of homework while homework is probably going to slow down, which is a really bad pun. But everybody that's everybody that's here again, please make sure you follow Rick Palacios. Rick, first time you and I speak, I think this was a phenomenal conversation, one that is important for people to just keep in the back of their minds, because the reality is, as much as we get nervous about equity volatility, housing volatility is far more impactful.
Yeah, no, thanks for having me, Michael. And I apologize for the audio. Next time I'll get it right.
All good. Thank you, everybody, for joining, and hopefully I'll see many of you in about 6 minutes. Cheers. Thank you.
Thanks.